Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, stock futures pushing higher this morning as the S&P looks to add to gains for a fifth straight day. The benchmark index is on pace for a strong weekly gain of more than 4.5% amid investor optimism on trade negotiations. This week, the S&P wiped out its losses year to date, now up 0.6% as of Thursday's close.
Plus, on the trade front, President Trump says he will set tariff rates for trading partners over the next 2 to 3 weeks. The president says his administration lacks the capacity to negotiate deals with all of its trading partners. Trump said Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick will be sending letters to trading partners telling them, quote, what they'll be paying to do business in the United States.
And Warren Buffett making some big moves in Berkshire's latest 13F filing. The company disclosing it sold off its Citigroup stake and doubled its position in Constellation brands to about $2.2 billion. Berkshire also made a new buy that it's keeping confidential. Meantime, investor Michael Burry of The Big Short fame, he revealed he's now bearish on both Nvidia and Chinese tech stocks.
U.S. stock futures pushing higher this morning with stocks gaining for a fifth consecutive day and wiping out year-to-date losses this week. So big question is, where do we go from here? Here with his own crystal ball, we've got Yahoo Finance's own Josh Schaefer. Josh, where are we going?
Brad, if I had this answer, I mean, we'd be pretty set, wouldn't we?
We would be.
Yes. We don't quite have that answer, right? But I'll tell you what people are saying and what people are thinking about, right? So I think what we learned this week is just from a straight up catalyst standpoint, it seems like trade negotiations and tariffs are still just at the forefront. Yes, we can talk about earnings, we can talk about Nvidia earnings coming in 2 weeks. I do think it's important, but I think just from a macro sense, it's trade negotiations. And it's the fact that we are now at a point where the market has become more optimistic on that trade outlook, right? So you entered the week with some economists estimating, I'll use JP Morgan's estimates from Michael Burry, he thought the effective tariff rate for the US with a China deal this week would fall to 17%. Well, now he actually has it at 14.4%. So if we're gonna use sort of the earnings phrasing, better than expected, right, is basically what we got on the tariff front entering this week, and that sort of set your direction for the market. But now you're getting to a point where you're pricing in a lot of good news. If you look at something like the S&P 500 valuation at this point, where we're at from a PE standpoint, you're at what a lot of folks are calling fairly valued. And so you're at a point where what can really keep sending you higher, and maybe it's the tariff rate actually coming lower than it actually is right now and getting some more deals. But I don't know, especially in the short term, we're looking at maybe next week, there's no real economic data next week. And people are already sort of looking through economic data anyway. So there's not a lot of, fundamental catalysts, at least in the next week, that you can really see, at least right now, that give you more reason for any kind of direction, whether it be up or down. It feels like we're in a little bit of a holding pattern. And when we've been in a holding pattern since Trump came into office, he usually takes the driver's seat.
Well, you just said something so important that I really want to highlight, which is we're not looking at the economic data that much anyway. That is a sea change, of course, from what we've been talking about for the past several years, coming out of the fastest rate hikes in decades here. To what extent does that continue to be true as these tariff negotiations unfold?
Economists essentially don't think that you are going to see the tariffs spill into economic data until maybe the May data, which would actually come out in June, right? So we're still maybe a month away from some of that, but probably early summer is how economists are phrasing it. So early summer would probably actually bring you to July. Maybe it's that June jobs report, the week of the 4th of July, and maybe you start to get it in the rest of the July data. But that puts you pretty far out, right? Before you can sort of feel confident in, okay, things are either starting to change or not starting to change. Because I think that when we talk overall catalysts and can we get back to record highs and how do we get there, at some point you need to feel confident in the economic story, right? That sort of was a key driver on the way down. We had these slowdown concerns. When do I start seeing data that I feel like has been impacted by tariffs and is strong? Because right now you're seeing some data that maybe is relatively strong, but then someone will tell you it's not impacted by tariffs. So then you just sort of look past it and it doesn't really matter, right? We had 2 good inflation reports this week and no one really seems to care.
Right, and so that raises the question of, does the Fed still matter to the same extent that Trump and the presidency was calling out and trying to place more of the onus and the blame for any of the tariff policy on, well, they're not lowering interest rates fast enough, which could offset what I'm doing on the tariff side.
I think the Fed still matters to some extent, Brad, but I think perhaps what matters more is just...
It's not the driver's seat right now.
It's definitely not in the driver's seat, right? And really what I think, I don't know. It just seems like we're going to argue about June or July cuts right now. That's what's going to move the market. That hasn't been what's moving the market, right? So how do you really get back to that point? I don't know. Maybe it's once we get to later in the year. If you just think about now how expectations have shifted, the conversation shifted to maybe they'll cut for the first time in September or December,
right? Which
is pretty far out at this point. So I think the Fed only matters if people and investors started to feel like they needed to cut.
Or if there was
the absence. I don't think people feel like they need to cut right now.
Or if there was the absence of strategic chaos, which is how the White House has essentially kind of encapsulated or at least driven the narrative around its tariff policy thus far.
Yeah.
Absolutely. Well, Josh, thank you so much for joining us to wrap up a slew of headlines over the week. Appreciate it. The other focus for investors has, of course, been earnings. A slew of companies warning or pulling guidance. Here to break down the winners and losers of earnings season, we've got Barbara Duran, BD8 Capital's Partners CEO and CIO. Great to speak with you this morning, Barbara. I want to start on an optimistic note. What is your headline takeaway from this earnings season that is positive? What's the biggest winner been?
Well, it's been a very good earnings reports coming in. We're almost done reporting for the S&P 500, and some 80+% have beaten on the EPS number. So I think that's a very good sign. And the average growth rate, and still a few companies left to report, is about 13.5%. So it's been good. Of course, that is the past, and the tariffs had not yet taken impact at that point. So, and we're seeing a lot of companies, they're either, keeping their guidance or spending their guidance, or very few have incorporated tariff impact because we don't know. As Josh was talking about earlier, in tariffs, there's still more to come. In the next 2 to 3 weeks, we may get something from the administration as to what it will be. Right now, the blended rate, depending what you're reading, is anywhere from 14.5% to 17.5%. That's still 4 to 6 times greater than it was at the start of the year. Tariff rates then were 2.5%. And you heard yesterday, Walmart, when they reported, saying they're going to have to be increasing prices. Right now, they're absorbing it. They're working with their suppliers. But if Walmart, who is the biggest, in the world in terms of sales, is saying they're going to have to increase prices, that means a lot of other retailers and other people will be. So the tariff impact is just starting to flow through. And so we don't know what's going to happen with earnings, but they are likely going to come down. And also one other point, on the PPI yesterday, which was a good number, CPI was even better 2 days before that, but the PPI, which is wholesale, for the first time, you really saw margins contract, which may tell you that companies are already starting to absorb some of the higher costs, which are clearly flowing through. So it's a question when it starts to show up. That's what, Josh was like, well, we'll see if it starts in May, June, later in the summer, but it will show up. So I think right now, earnings have been great. We've got jobless claims yesterday were good. Inflation numbers are good, but that's probably the peak in terms of good news. So I think we're in a trading range. The market's back to a 21 times PE versus just 18 last month. So, we may have more to go just out of sheer momentum, but I think you've got to be careful here in terms of adding new positions.
Barbara, I'm glad that you hit the good and also the bad, because I didn't want to have to be the Debbie Downer and ask for the potential bad here. But perhaps I'll ask for where the relief could ensue, because we've had some companies either reaffirm their guidance for the full year, or some of them pull the guidance in entirety for the full year, and then we've also seen a range. So it's kind of a differing of strategies that we've seen over the course of the earnings season. But does that actually set the environment or set the stage for potential relief if things aren't as bad as some of the companies were laying out or pulling their guidance around because of that lack of clarity, and then things, don't end up as dire as could have shown up in their data? How might we see portfolios position around that relief?
Yeah, well, it's a good point. And I think right now what we've seen, today, as you pointed out earlier, if today closes on an update, it'll be the 5th day in a row. And we've already recovered some 75% of the drawdown that we had after the April 2nd tariffs, which shocked everybody, in terms of the size there. So I think that we will just have to wait and see. It's going to take time for things to flow through. It's not going to be positive. One thing, this has all been driven by policy out of Washington. So if suddenly they decided tariffs would be 5%, I mean, that would be monster for the market because, we entered the year in good shape in terms of earnings and inflation coming down, and you continue to see inflation coming down in the soft goods side. What we're seeing now, the tariffs really have to do with hard goods, which have been in deflationary mode. So that's really where the surprise could be. We don't expect that. So that would be a real positive. I think the Fed is not in play right now. They really are like us going, we don't know. We don't know. We expect the economy is going to slow. I mean, people are out there at 1% growth for the year, down from the beginning, and inflation coming down, was coming down, but they don't know. How much will inflation go up? Will it be one time, a price adjustment, or will it be embedded? And that's where the Fed is just waiting to see. So I don't think we're going to see any relief from the Fed cutting rates in the next few months and maybe longer.
Barbara, thanks so much for taking the time here with us this morning ahead of the opening bell. Appreciate it.
Great to see you.
Service at the nation's third largest commuter railroad, the New Jersey Transit, is suspended until further notice as locomotive engineers strike. The members of the Brotherhood of Locomotive Engineers and Trainmen walked out at midnight, marking the first strike at the agency for transit in over 40 years. The union saying in a statement, quote, after 15 hours of nonstop contract talks, no agreement on a wage increase was reached. Workers are pushing for their first raise since 2019, asking for an average yearly salary of $170,000. They estimate the current average to be $113,000. Meanwhile, New Jersey Transit calls the union's proposed wage unaffordable. New Jersey Governor Phil Murphy worries that giving the union too much could endanger NJ Transit's financial health, saying, quote, we must reach a final deal that is both fair to employees and at the same time affordable to New Jersey's commuters and taxpayers. The stoppage will impact about 350,000 commuters who work in New York City and New Jersey every day. New Jersey Transit encourages those who can to work from home and limit travel on the system to essential needs only.
And coming up here on the morning brief, we're going to count you down to the opening bell as stocks look to close out a big week of gains. Plus, we'll check in on shares of Take-Two as the brand theft automaker delays its big release. And we'll look at what Warren Buffett is doing with his massive cash pile. We'll reveal the Oracle of Omaha's latest moves and much more ahead on Morning Brief.
Now time for some of today's trending tickers. We're watching Novo Nordisk, Charter Communications, and Take-Two. First up, Novo Nordisk announcing that its CEO is stepping down. The weight loss drug maker citing recent market challenges, and the CEO is expected to stay in the role for a period of time to ensure a smooth transition. Shares moving lower on this news, down by about 3.5% here. We do know that this is going to be a period of transition, supporting that smooth transition to new leadership. A search for Lars Jorgensen's successor ongoing. And many of our Yahoo Finance faithful will also remember that this was our 2023 Yahoo Finance Company of the Year.
Yeah, and it's certainly been a fall from grace. The company had that sort of first mover advantage when it comes to weight loss drugs, but we're now seeing consumers really switching to Lilly through their Lilly Direct program, for example, and some other competitors in the space. While Novo continues to sort of struggle here, they have been trying to kind of regain their lead and create other avenues for revenue through other drugs, but they just haven't been able to make that work here. And so you see, given that the shares have lost nearly 60% since their peak last summer, we're now seeing, of course, this CEO exit. The shares down about 3% at the moment. Well, next up, Charter Communications and Cox Communications agreeing to merge, combining two of the biggest cable providers in the United States. The deal valuing Cox at $34.5 billion here, including some debt. The combined company would be the top broadband operator in the U.S., as I said, increasing Charter's subscriber base by more than 20%. I think that's in part why you are seeing this mild move to the upside. pre-market here, positioning the charter to be able to compete more in an environment where we continue to see these convergings happening.
Yeah, that's exactly what they're talking about within the release for the company as well. And this combination augmenting their ability to innovate, provide high quality, competitively priced products, outstanding customer service, millions of homes and businesses. At the end of the day, the environment is changing quite rapidly here, and some of the takeaways that investors should be looking for going forward from this point, especially when it comes to the consummation of this deal and coming over the finish line in full. Wall Street and how they're going to be looking at this, $4 billion in cash in consideration for the transaction. Cox Enterprise is going to get $4 billion in cash, $6 billion notional convertible preferred units in Charter's existing partnership, and then additionally they're going to get about 33.6 million common units in Charter's existing partnership as well. Implied value there of about $11.9 billion here. So I think we're looking for this and this total enterprise value to have this adjusted EBITDA trading at a 6.44 times multiple, and that's based on a few of the existing 2025 factors that they've already laid out. Also here, let's talk about Take-Two Interactive here for all the gamers out there. Take-Two Interactive topping quarterly sales estimates boosted by its latest basketball game and Grand Theft Auto Online, GTA Online. But the video game company is forecasting 2026 bookings below expectations. The delay of its highly anticipated GTA 6 Grand Theft Auto expected to weigh on results here. You're taking a look at shares of Take-Two Interactive here. Pre-market, they're up by about 1%. The last time a GTA was released, Russell Wilson was winning Super Bowls.
That's exactly right, Brad. You know, that's the kind of commentary I love, because the only thing that I had to add to the conversation was some sports commentary from my house, which is that, you know, Take-Two is the 2K operator.
Yes.
So people love that who are close to me. But it's all about Grand Theft Auto 6. I think that this is a stock that tends to move off of whether or not this game is going to be released sooner rather than later. So for those investors in our audience listening in on Take-Two, just really try to get some information about when GTA 6 is coming out, and that's potentially what's going to be able to move this stock price. Despite the forecast here for that game release, we are still seeing shares up a little over 1% at the moment. For our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Let's take a look at Magnificent 7 stocks. Still moving to the upside today after rallying this week along with the broader market recovery. Nvidia is back in positive territory for the year, with Meta and Microsoft hovering around the flat line year to date. Joining us now, Kimberly Forrest, Boca Capital Partners founder and chief investment officer. Kimberly, always great to have you on here. To what extent do you think this most recent rally is a signal of a comeback for tech for the year?
Sure. Well, it's really hard to divorce yourself from, well, the thing that's growing, and that would be tech. You know, it's there are parts of the market that have languished, but I think everybody acknowledges that AI is a thing, and the companies that count, which are those in the Magnificent 7, are not only benefiting from it, Nvidia, I'm talking to you, but also driving it, and that would be Microsoft, Amazon, Meta, and Google. So I think because AI is still in the forefront of most growth-oriented and certainly momentum-oriented investors, that's why they love them.
And so, as we're still waiting for, of course, the poster child of AI in the semiconductor trade, and really the most magnificent member of the Mag 7, Nvidia, to report earnings, what can they say that either further solidifies the rally at least back to break even over the course of the year, especially knowing that Nvidia and Apple were two of the larger names that had actually led some of the declines and essentially been predecessors to the market decline more broadly that we had seen at the start of 2025?
Sure. Well, I think the AI trade is always in question because a lot of people have tremendous amounts of hopes on what it can actually do. And if you let me, I'm probably going to be a little bit of a wet blanket on that because of Meta's latest announcement that Behemoth would not roll out for unspecified reasons, right? They just said, well, it's not ready. We're going to delay it, a couple months, blah, blah, blah. But I think that AI really is a force for the future, and people really want exposure to that. So, why not? Why not pile into the companies that could benefit from it or making it and actually get paid for it. Oh, back to Nvidia. Sorry, I got lost there. Nvidia needs to say that its chips are in demand and that there are no other competitors currently. Because everybody, if you make a semi, wants to replace Nvidia as the preferred chip. So those are the two comforting messages that Nvidia has to say.
Well, Kimberly, I know that you have a particular interest in LLMs and Meta's behemoth, but I want to tie it back to Nvidia, to the point that you're making here, because if we as investors can't really get clarity on who's going to have the best LLM, what the timelines are going to look like, the argument I've heard from sources like Dan Ives is you buy what's juicing the LLMs regardless, aka Nvidia. How do you rate that framework of thinking for investors?
I think that's going to work right up to the point where it doesn't, because what this is a momentum investing play, right? And I love momentum investing when it's working, but here's what the problem is. The top buyers of Nvidia are playing this game that they are going to continue investing at the same rate their competition is, because the minute one of them takes their foot off the gas pedal, they're going to become irrelevant. Not just lose first place, we're talking irrelevancy, right? So that's why Dan's argument works. Now, I'm not saying they would collude, but they might get to a point where they say, oh, gee, the promise of truly autonomous learning, where we don't have to have any human governors on there, they just know the truth. If that can be formulated or programmed, we'll say, maybe this is a winner in perpetuity for as long as I'm going to be in this business, right? But I don't think that's the case. So I think there's going to be bumps along the way where it will call for lower investment, and by lower investment that you don't need every last Nvidia chip that's coming off the line.
What do you believe about Magnificent 7 performance relative to the rest of the 493 in the S&P in your outlook?
Well, I think it's merited. They're showing growth. I am a growth at a reasonable price investor, so I don't necessarily own a lot of the Magnificent 7. But I do know this: Wall Street over time rewards growth. And these companies have proven year after year that they have some kind of magic formula to get whatever customers they need. And it's not direct in many of their cases, right? Because Google and Meta, the users don't pay for it, the advertisers do. But as long as you can get paying customers to keep paying, they're going to win.
Kimberly, good to see you. Thanks so much for taking some time here pre-market.
Thank you.
Coming up, we bring you the opening bell on Wall Street. Much more ahead on Morning Brief. Just seconds away from the opening bell and taking a look at the major averages here. We are higher across the board for the futures activity right now. As we're taking a look at the Dow futures, flat just barely to the upside. The Nasdaq 100 futures, that's up by about 0.3%, and the S&P 500 futures, you're seeing that up by about 0.1%. Let's fire up today's esteemed bell ringers. At the Nasdaq, you've got Galaxy, friend of the show, Mike Novogratz of Galaxy. You see him there with the broader team ringing the opening bell at the Nasdaq. And then additionally here, you've got ALS United ringing the opening bell at the New York Stock Exchange, down on Wall Street. All right, let's take a look at where we begin today's activity here, as we were pointing higher across the board for the major averages. As of right now, the Dow still flat, just barely to the upside. That's where we see the opening cross coming in at. The S&P 500, you're seeing that fractionally higher by about 0.1%. That Nasdaq is calibrating here for a hot second, and there you go. Just as I call for it, it's up by about 0.2% as we begin trade. Let's take a look at some of the sector activity out of the gate here this morning. You've got more advancers than decliners pulling up the caboose though right now. XLB, that's your material sector, folks, down 0.25%. However, leading the pack, oh yeah, healthcare. That's though after what's transpired over the course of this week. Let's just kind of put that into view. We'll put this on a 5-day view. Why not? We're down by about 1.3% over the course of the past 5 trailing sessions here. But catching a little bit of a bid here this morning. And then additionally, you've got 3 laggards and the rest of them, 8, are gainers right now. Taking a look at the NASDAQ 100 here too. Let's just gander at these mega cap tech stocks. Fractional declines here for Microsoft. That's down by about 0.7%. Meta also moving lower out of the gate by about 1.5%. Past 5 days, still holding on to some very solid gains, though, of about 6.97%. However you want to round that off, just call it up. Taking a look at Google, Alphabet, whatever you call them higher as well. That's up by about 2.4%. That chart not loading, so we're just going to X out of that one. And then lastly here, let's take a look at the Dow 30 components here. If the Interactive will continue to collaborate with me for just a hot second as we're taking a look at the equal view, well, ultimately, I've asked all I could of the Wi-Fi Interactive. So let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving.
Thank you. I want to go back to the indices and just kind of track what has been happening this week. Very bullish reaction. And you can start with the Nasdaq, which is now up 6% this week. And in fact, this is the third week in the last 6 that the Nasdaq has been up 6% or more. And we'll see if this loads here. But just to kind of continue the commentary of and some of the themes that I've been tracking throughout the week, the natural question is, have stocks gone too far, too fast? And the answer is maybe in the short term, we might expect a little bit of a pullback. And there you can see that bullish price action, 6.78% over these 5 days. But then we switch over to the S&P 500. That is up 19% in 26 days. And I'll just roughly give you 1 month of that slice right there. So the bottom line is we are set up long-term bullishly here. And it's hard to argue that based on historical stats. But in the short term, we could see a little bit of resistance. And I'm going to move on here to the 30-year T-note yield. And this is a 1-month chart. What I want to show you is intraday, just overnight, very briefly, hit 5.0%. And this is the 4th time since 2023 we have hit that level. That's a very important level. The bond market is something that Trump watches. And for the most part, most people don't want to see yields go above 5%. That just signals a lot of problems. But we have backed off, and so everything's okay for today. But that's something we're going to monitor going forward. Let's take a look now at the sector action. I'm going to punch this up to a 5-day view. It's been interesting to track the strength. I was looking at the strength in the Nasdaq. Can also see this in the tech field as well. XLK up 7.6%. XLY, that's consumer discretionary, up 6.8%. Only those 2 sectors outperforming. And then healthcare. Healthcare has been a kind of a disaster this week thanks to United Health was a big part of the issue, but also some other issues as well. And just punching up the Nasdaq 100, want to point out that in the Mag 7, we have both Tesla and Nvidia surging, each of those surging by more than 15%, more than 16% right now. In the lower left, you can see Nvidia up 16.5%, and then we got Tesla closer to the top here, up about 16.5%. Let's punch up a year-to-date. Well, let's actually go down to a 5-day, and you can see what's been happening over this time period. And 10 days looks even more interesting there. Excuse me, that's Broadcom, so touching the wrong thing right there. Nevertheless, seeing a lot of strength in semiconductors, so that's going to be my segue to the next segment of this presentation. Looking at semiconductors this week, Jonathan Krinsky had a really interesting stat out. He's looking at the SOX index itself, and he's noting that it is 16% above its 200-day moving average. That's very technical, wonky stuff here, but that is the first time this has happened all the way since 2002. So a pretty notable development for semiconductors there. And Nvidia has just been leading the way all week long, thanks to some initiatives by Trump over in the Middle East, just pointing to the continued story that we have seen evolve in AI. And there's that board right there. Taiwan Semi up 10% this week. Broadcom just hit that up 11. Even AMD up 14% in that upper right corner. I want to end on gold because it hasn't been the best week for gold, and it looks like it's kind of topping right here. It's down 1.36% today, and let's see if I can punch up a chart there real quickly. Here's the 10-day price action. You can see it's down 6.71%, and if the year-to-date cooperates, I'm going to show you we have been putting in what looks like an M top. And that is just when, well, it's not cooperating right now, but basically it looks like the letter M. It has broken the neckline and it's coming down a bit. So a little bit of cold water thrown on the gold trade there. We'll have to see how this evolves. And on that note, I will send it back to you, Maddie.
Jared, thank you so much, as always. It's time now for today's strategy session. Stocks opening in the green today as tariff concerns move to the back burner for investors. However, the president did reveal he plans to send out tariff plans for trading partners in the coming weeks. So, should you stick with U.S. stocks or look to emerging markets? Joining us now, Jeffrey Kleintop, Charles Schwab's Chief Global Investment Strategist. Jeffrey, always great to have you on here. So, given the backdrop that we're in, the pending tariff negotiations to come, do you buy U.S. or do you go global?
I am concerned about the magnitude of the rally we've seen coming back. The markets just might be a little too enthusiastic that the trade worries are behind us. Remember, in the first Trump trade war with China, after a 90-day trade truce that began on December 2nd of 2018, the two sides did not resolve their differences and tariffs increased again. And, you know, the trade frameworks so far are far from completed agreements. They can take a long time. Also, this semiconductor tariffs and related hardware supply chain, along with pharmaceuticals, are now out of their comment periods. Those ended May 7th, and the new tariffs can be announced at any time. So I'm a little concerned about leadership that we're seeing in the markets right now, particularly in tech hardware. I think that's vulnerable. Instead, I am looking to emerging markets. They're outperforming this quarter. They outperformed last quarter. And you know what they did in every single quarter of Trump's first year of his first term, as we saw better growth out of China and other parts of the world. That's echoing in a lot of what we're seeing so far this year. So I think we can continue to see emerging market outperformance along with European outperformance of U.S. markets.
Does that mean that you're trimming some of the U.S. exposure or just holding for now?
I think if you're an investor that over the last several years has really let your U.S. and tech exposure really drift to be a dominant portion of your portfolio, it is not too late to rebalance. Europe, emerging markets have outperformed this year, but only by a small amount relative to the last, say, 10 years. So I think there's still room to move your portfolio more into emerging market and developed market equities.
And I wonder, too, how you're thinking about emerging markets like China. We obviously had Michael Burry of Big Short fame out with his 13F filing indicating that he is trimming exposure to Chinese stocks. To what extent do you think investors should follow that move?
You know, I think China's still got some room to go. Look, China has really been a dismal place to invest for the last 3 or 4 years. Valuations are way below their long-term average. And this year, China has 3 budgets. And if you combine the 3 of them, you get total deficit spending equivalent to 11% of GDP unveiled this year at China's national leaders, their National People's Congress meeting back on March 5th. They've only just started to implement that after April 2nd. So we're just starting to get the data on this massive amount, record-breaking amount of stimulus in China to turn around the 40 to 50% of their GDP that is consumer spending. Remember, only 3% of China's GDP is tied to U.S. exports. So if they can really turn that around, that can continue to mean strong momentum for Chinese equities, which are already up nearly 16% this year.
You know, it's not too early to start thinking about next earnings season because that's when a lot of companies are going to be giving us some updates on where they ultimately performed given the amount of clarity, or lack of clarity, I should say, that they were citing in this most recent and this current still yet to end as we're waiting for a few more retail names that are going to be scattered over next week and then a few other companies trickling out. So what does that set up for the next earnings season and whether there is certainty that's put back on the table?
Obviously, we heard a lot this earnings season about the uncertainty and maybe 2 different paths that earnings could take for many big companies. We are still in the European earnings season. It tends to lag those in the U.S. We're only about 2/3 of the way through it. So we're hearing these comments way post-Liberation Day now on what they're seeing going forward. Of the 230 companies in the Stock 600 index in Europe that have reported earnings so far, 60% beat estimates in 60% beat estimates in the first quarter. That's 6% better than usual, and the guidance has been improving here in recent weeks. As a matter of fact, we continue to see rising earnings estimates in Europe in contrast to maybe the downgrades that we saw in U.S. earnings growth. So I continue to favor European stocks on that rising earnings and economic growth backdrop, the combination of fiscal and monetary stimulus this year, regulatory reforms as right-leaning governments elected last year begin to implement policy along with attractive valuations and relative political stability adding to a rising euro.
Jeffrey Kleintop, great to see you. Thanks so much for taking the time here with us.
Thanks for having me.
It's time now for Chart of the Day. Let's send it on over to my co-host, Madison Mills, for a look at what Warren Buffett is buying and selling.
That's right, Brad. Where is the GOAT of investing putting his money? Luckily, you don't have to guess. It's 13F filing season, and that's when hedge funds are required to disclose what they've done with their portfolios over the course of the quarter. To be sure, it's obviously backward looking, but it's Buffett, so investors still want to peek at how the Oracle of Omaha is allocating capital. So let's dive into Buffett's news. As we know, he was sitting in cash and avoided the market volatility as a result. But looking at his exposure here, he sold his remaining Citigroup stake, also trimming his Bank of America holdings here, doubling his exposure to Constellation brands, which is interesting given that leverage to the consumer. What's really interesting, and we're trying to get a hold on here, is that he is keeping a confidential new buy. As a reminder, obviously Buffett sitting in a lot of cash because he was able to get out of the market prior to a lot of the volatility. And the question is, what is this new buy going to look like? How is he deploying that capital? Historically, Buffett likes to buy things that he knows, whether it be Coca-Cola or McDonald's. So perhaps that is a signal of where he may be putting that cash to work. Brad?
All right. Thanks so much, Maddie. Coming up, the first fintech company to go public since 2021, what eToro's debut means for the IPO market this year. That's next on Morning Brief.
We always had the vision and dream of being listed on Nasdaq. We are a capital markets company. Our customers trade stocks from 20 different capital markets. We're passionate about crypto markets, and I always believe our next stage of growth is going to be as a public company.
That was eToro's CEO after the stock and crypto trading app debuted on the Nasdaq, opening at over 34% of its original IPO price. Stock down a bit this morning. Joining us now, Phil Hazlitt, EquityZen's co-founder and chief strategy officer. Great to have you on this morning. I'm curious how you view the eToro IPO. Do you see it as a catalyst for the broader IPO market going forward this year?
Yeah, good morning. Thanks for having me. I think we're approaching it with kind of cautious optimism. It's always helpful to see a company, particularly in fintech, come public. Do I think it's going to completely open the floodgates? I'm not so sure. But the fact that there has been positive market response to a company within fintech, I think bodes well for the overall sector. But we still have overall macro concerns, I think, that are keeping other companies waiting kind of on the sidelines for a bit more time.
What are the raises that we're looking at, Phil, comparative to IPO cycles past, and how much more these companies are looking for as they enter into the public markets in order to kind of sustain their business and scale to the point that investors are expecting?
Totally. So we are nowhere close to kind of the heights we saw in 2021 as far as IPO activity. In fact, I believe this is really the first venture-backed fintech IPO of any size in almost 4 years, which is pretty wild and gives you a sense of what other sectors are kind of dealing with within tech to come public. What I expect companies are doing is that there are plenty of really healthy companies that have planned for their filings to go public and are seeing that this is one really good window to do so, particularly the fact that you have kind of volatility at a pretty low number relative to the last few months. You have relative stability at a macro level, right? And that's very relative, though. And the last thing is, it's pretty rare to go public in the middle of the summer. It's a generally slow time for IPOs. So I think a lot of companies consider that maybe between now and, say, the end of May or early June might be their last shot before, call it, September or October.
Yeah, good reminder that those vacations always come into play, even for the IPO market. I am interested in your take on this. I had an investor chat earlier this week, and this investor was telling me that the IPO market isn't so much driven by the price of the S&P 500. It's more so just the uncertainty, the volatility that still exists in the background, to your point on that volatility. Given that we still have these trade negotiations pending, to what extent do you think that even if the market rallies, if that trade uncertainty remains, that could be a headwind for IPOs?
It's a great point to highlight. You know, the S&P, I think about 26% of the weighting in the S&P is dominated by Mag 7, right? By the top 7 stocks. And so the S&P is not really the harbinger for how to think about the IPO window because it's really just a heavy concentration. What's more important is how the other 493 companies are performing. That's piece one. Piece two is as quickly as volatility can go down, it can come back up, right? It was only a mere 5 weeks ago that the VIX, the volatility index, was at 53, and now we're at 17. Right? So things can come and go. We like to joke that with this administration, change is only one tweet away. And so things can come back quickly, but they can also go away. And so I also would point to the fact that the retail investor sentiment, despite the S&P coming back into the black for the year, retail investor sentiment is relatively tepid, right? About 1/3 of people are bullish, 1/3 are bearish, and 1/3 are neutral. That is not the dream scenario you'd want to have to go public. And so it's kind of like this weird feeling where the S&P looks better, things feel better, tariffs are maybe off the table for a little bit, and yet we kind of have this little knot in our stomach as a company of, is now the right time? And I think that's transpiring into the IPO markets as well.
Does geopolitical tension also add a ceiling to the potential type of fervor that we could see for international companies that come to list on U.S. exchanges? As we know, in years past, a lot of those companies had said that they want access to U.S. investors, and there are a myriad of different ways to do that, whether you just list some ADRs, American Depository Receipts or shares. So how is this kind of environment more difficult for an international company that wants to target specifically the flows that they're seeing within the equity markets in the U.S.?
It's a great question. I think there's equal and opposing forces right now on why it's good and bad to do that as an international company. One that's in support of it is that there's a general theme towards investing in emerging markets, right? And so by extension, you could think of an international company bringing their listings to the U.S. is one way to catalyze or kind of capitalize on that investor interest. The offsetting challenge, of course, is that there is a lot of geopolitical risk. There's uncertainty on tariffs, and that bodes against you. So, it's hard to see which one shakes out better than the other. But predominantly, as you know, at EquityZen, we're mostly following the U.S. IPO market. There is a lot of uncertainty still there. I think that's probably the case internationally as well. Hopefully, though, eToro is an example of a company that is mostly built internationally, but has a U.S. presence, and I think it's been really successful. And we've also heard that Klarna's plans would be to move their listing over to the U.S. That also is another sign and maybe a leading indicator that more will follow.
Phil, great to see you. Always a pleasure to check in and get your insights on the industry and the broader IPO landscape here.
Of course, thank you.
And you can track more private company data, including valuations and funding rounds, by scanning the QR code below. We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. Republicans are racing to advance a sweeping tax and spending package dubbed the One Big Beautiful Bill, which would cement a big part of President Trump's economic agenda. They're hoping to get a vote in the House before Memorial Day weekend, but there are some internal divisions that threaten the success of the bill. Here with more, we've got Yahoo Finance Washington correspondent Ben Werschkohl. Ben, just give us the latest color around the bill.
For sure. Yeah. So good morning, Brad. So Speaker Mike Johnson has a tough job this week. He's trying to get to this Memorial Day deadline you mentioned, and he's run up against basically three groups of lawmakers in his caucus, three groups of Republicans who are dug in. They all have the ability to sink this effort, and they're all, at least for the moment, pledging to vote no. The first issue here is on the tax front. It's the state and local taxes. As the graphic showed there, the current plan is to raise the SALT cap from $10,000 annually to $30,000 annually. That is not enough for a group of kind of blue state Republicans who are talking about a deduction that's much higher than that. That's been a series of tense meetings this week. They call themselves the Salty Five, and the margins are so small that they have the ability if they hold together. The second big issue at the moment is around Medicaid. To help pay for this, there's a lot of ways to trim Medicaid benefits that could cause millions of people to lose their health insurance in the years ahead. That's about what a bunch of analyses show. That has genuinely spooked a lot of Republicans who will say, this is not what we're about, is causing people to lose health care. A big proponent of that is in the Senate, Senator Josh Hawley of Missouri, who said, I will not vote for this in the Senate if it gets that far, or I will change it. So that's a giant issue. The third group is actually on the opposite side of the second group in a lot of ways, which are fiscal conservatives who say we need deeper spending cuts to make this bill more fiscally responsible. There was kind of a revelation this week when the bill was released that a lot of these spending cuts are delayed until 2029, which is notably when Donald Trump would be scheduled to leave office. That raised a lot of ire that these spending cuts in here aren't real, especially even on the Medicaid front. So there's a group there that says we're going to vote no if that isn't addressed. The front on it today is the House Budget Committee, which is trying to kind of compile this whole bill together. It runs over 1,000 pages at the moment, but the fiscal conservatives are sort of especially powerful in that arena. Chip Roy of Texas is a big figure there, and he told reporters this morning this hearing should recess and they should kind of go back to square one. So it's not a great sign. The hearing is going on now, but they need some resolution if they can get to this deadline for a vote next week. Others are saying that this is inevitably going to push and is going to be kind of a summer or even a fall-winter thing, but we'll see how this hearing plays out today.
We certainly will, Ben. Thank you so much. Appreciate it.
Thanks much.
That's going to do it for the morning brief. Join me next hour for more analysis on Catalyst and then Brad for Wealth. After that, stick around.